and good afternoon. You're watching Business Plus. India's services sector moderated in March, albeit registering a slower expansion. The sector's Purchasing Managers Index PMI fell to a 57.8 from February's 12-month high of 59.4, according to data released by S&P Global. With March's reading, India's services PMI has now been above the key level of 50 for 20 months consecutively. Remember, a reading above 50 on the PMI index indicates expansion in business activity, while one below it signals contraction. Earlier this week, S&P Global also released the manufacturing sector's PMI for the month of March, which stood at 56.4, a 3-month high. This was also the 21st consecutive 50-plus print for India's manufacturing PMI. With me at this point in time is Sunil Kumar Sinha, who's an economist. Also with me is Suyash in the newsroom. Suyash, how are we reading these numbers?
So Shweta, as you just mentioned, the services activity has moderated from 12 years, and I think Sunil will help us understand that better, why the moderation was there. We need to understand that the expansion in the services sector is still above its long run average, which is about 53 points now. So, and as you just mentioned, the service sector has expanded for 20 straight months. The manufacturing sector has expanded for 21 straight months. So again, looking at the bigger picture, it suggests sustained expansion in both manufacturing and the services sector. And also, the services sector had been the main driver of growth in the last quarter of 2023. And now we are seeing the manufacturing activity, which has picked up, and it's at a 3-month high, right? So it has retaken that mantle of being the main driver of growth now.
Okay, so there is an expansion both in manufacturing, as we can see, and in services. Run us through the numbers once again and tell us how good are they looking? Are they looking good at all? Because we know there's been a slight moderation in expansion as far as services is concerned.
Yeah, so there is a slight moderation as far as the services sector activity is concerned. So again, we need to remember, in February, we were at a 12-year high, right? So we can expect some ease in the pace of expansion there. At least in March, we have seen that. But again, the big thing is that the manufacturing activity has picked up, and it's now at a 3-month high, right? And if we look at it, for 20 straight months, we have seen expansion in the services sector. For 21 straight months, we have seen expansion in the manufacturing activity. So I don't think there is need for us to worry about the macroeconomic positioning of India.
Okay, what do these numbers tell us in broad parameters?
So, the the services index is calculated basically on 5 major components: the business order, the output, employment, suppliers delivery time, and inventory levels. And as you just had mentioned, again, a reading of 50, above 50 suggests expansion in the activity, and a reading below 50 suggests contraction in the activity, both at manufacturing and service level.
Okay, we are about to get Sunil in, I think, a couple of minutes from now, but let me quickly repeat what we are getting at this point in time. Services sector has contracted very, very marginally, we're given to understand. It was at 59.4, it is now at 57.8 for the month of March. So there is a slight contraction there. The March's reading have been above the 50 level, the level of 50, which indicates that there is a constant expansion in business activity. Remember, anything below 50 means there is a contraction. Now, as far as manufacturing PMI is concerned, for the month of March, it stood at 56.4, which is a 3-month high. Now, remember, this is the 21st consecutive 50-plus print for India's manufacturing PMI. So, good news there as far as manufacturing and services in India is concerned.
Definitely. At this point, I would also like to mention that we are outperforming the global economies as well. So, at both services and manufacturing level, right? So, but there is a bit of a discrepancy there. The macro numbers are suggesting that, India is outperforming the global economies, yet the India stock market has given negative returns this year, whereas other markets, in some cases, they are up about 6 to 12%. So it's very interesting to see that discrepancy. Now, Indian market was an outperformer for the last 2 to 3 years. So maybe there is some moderation in returns in that regard, but again, the numbers at the macroeconomic level suggest that India is doing pretty well, yet the stock market is not really reflecting that sentiment.
Okay, interesting take there. India doing really well when it comes to macro numbers. We, of course, continue to track that very important story on various parameters, from consumption to manufacturing to services. India seems to be doing really well, and we're waiting, of course, for that to reflect in the Indian stock market. Shifting focus now. Two-wheeler sales, an important economic indicator, is yet to reach pre-COVID numbers. It is a sign of tepid consumer sentiments in rural India, which is a major market for two-wheeler makers. According to numbers released by Federation of Automobile Dealers Association, sales of two-wheelers have been adversely affected by inflationary pressures and stress on rural economy. But at a time when car sales have peaked, what are the reasons behind lag in two-wheeler sales? We will discuss all of that and more. Saurabh Oveja is going to join us very, very shortly. My colleague Karthik is here with me. Karthik, two-wheeler sales, they're not looking very good. What does it tell us about the rural economy?
No, so, we have to look at this data in perspective, Shweta, and there are multiple reports that have been released. Now, have we seen a real contraction in two-wheeler sales? We have not, fortunately. What seems to be noticed and observed is the fact that we haven't reached the pre-COVID levels when it comes to sales of two-wheelers. Now, we understand auto is an important sector and the health of the economy is reflected in the auto sector. So if you're looking at four-wheelers, it talks well about urban India and the upwardly mobile India, whereas when you look at two-wheelers, it talks to us about the health of the rural economy. Now, on an average, numbers have been growing. We have seen the numbers on a Y-on-Y, year-on-year, as well as on a month-on-month basis on the data that came out in March. We've seen a growth. I think the challenge right now is that these numbers still don't reflect the numbers that we had achieved in the pre-COVID era. Now, is that a fair benchmark or not is something that, that one again has to look at in another context altogether. Now, the point being, we are seeing there is inflation for one, right? Number two, we are seeing that loans have become expensive. So while the cost of the product all across, not just automobiles, every industry, every product has been hit by inflation. At the same time, loans have also become expensive because of the rate hike that RBI has been doing consistently. So what is really, helping the growth not reach its pre-COVID levels is not as much about rural demand per se, but demand at the price at which the asset gets acquired. So I think the larger problem is that rural economy has perhaps not grown at the same clip as the rest of the country. And we saw the World Bank data that came yesterday as well.
Absolutely.
So we are saying we are going to continue to grow at 6.3% versus 6.6%. Asian Development Bank, on the other hand, said 6.4%, so minus 0.1% there. But the fact is there is growth, and that calls for reason to celebrate and believe that we are on the right path.
Okay.
Now, should we really look at it at a pre-COVID level? We saw the recovery was also sharp, and during COVID, the rural sector was obviously far more hit than the urban sector. So maybe they are holding on to cash. We also know for a fact that monsoons are likely to be a problem this year, right? There's unseasonal rain. There are chances of the El Nino. So maybe the rural folks are holding on to their cash, but this doesn't really reflect as much in other indices. Even if you look at PMI, what you and Sayash were talking about earlier, if you look at PMI, there is overall growth. It is 57% for services, 57 points for services, and about 58 points for services and manufacturing put together. So overall, we don't seem to be in a bad position.
Okay, Saurabh is joining us. Saurabh, we're not in a bad position. That is the assessment here. But, coming back to the sales of two-wheeler, automobiles in general are doing well. Passenger vehicles are doing well. SUVs are selling like hotcakes. But there's not much demand for two-wheelers just as yet. Although there is a moderate expansion, we're not seeing the pre-COVID levels just as yet. What do you make of these numbers?
Yeah, great. You're right, Shweta. And at the same time, if you see just the performance in the last financial year has actually already seen a double-digit rebound. What we do foresee is a concern in the coming year. I think that's what we got to be worried about, because usually there is a a lagging effect of any kind of inflationary pressure. We already can see that even with the four-wheelers, not just two-wheelers, almost all the brands are sort of re-rating their expectations as far as their growth in this financial year is concerned. And that's something that you could expect in the next 2 quarters to show up as a much more serious concern. So the rebound already happened very quickly, if I were to summarize. But we may be, looking forward to another significant dip, in the next couple of quarters.
Okay. The regulatory compliances seems to be also one of the major reasons due to which two-wheeler prices are rising. We know that two-wheeler prices are on the rise. What are the ways in which industry can counter this impact? Because all in all, it's just not about people not buying. It's also about the rising prices of two-wheelers at large.
That's right. And so for any industry, two-wheelers in particular in this case, the way to counter the impact of rise in prices, whether it's because of better emission controls or because of inflationary pressures or the monsoon. But the fundamental here is that are we creating better products? And what you do see, brands working towards is, a significant improvement in the technology space. So they're, for example, the anti-braking systems or the slippery clutch technology. All of these things are now becoming dominant features of the products which are getting launched in the market. The other big trend, of course, when it comes to two-wheelers, which we cannot ignore any longer, is the EV two-wheelers, which is becoming very important. But if one was to run and even though it's growing at a very, very high rate at the moment, but the base is small, but if one was to run a short survey of potential buyers, a lot of two-wheeler buyers still do not trust the EV two-wheeler ecosystem. So I think there's pressure on brands to innovate on that front, both in terms of marketing as well as product improvements. And that for sure is going to have a positive impact on the top line, even though it might impact the bottom lines in the short term because of these incremental expenditures, both capital and operating.
Sort of help us understand, would it be fair to classify EV scooters also in the same category as the rest of the two-wheelers when we talk about the health of the rural economy? Do you think the uptick in EV scooters, EV two-wheelers will happen as much in rural as it is likely to happen in urban?
Not really. I don't expect that to happen. A simple reason being that the quality and the consistency of electricity in the rural markets is still not at the level that we'd expect it to be. In fact, there's still a lot of urban markets where you don't always have consistent electricity supply, even though the situation has improved dramatically over the last couple of years. So the EV market would first take off in the urban markets. We're still about less than 5% of the total two-wheeler market as far as EVs is concerned. So expect it to go from super urban to semi-urban before it really goes to the rural. So still a couple of years away before rural really picks up EV as a preferred choice.
Right. So we also saw FADA release some data yesterday, Saurabh, and it categorically stated that passenger vehicles are likely to see a 14% fillip in this financial year. At the same time, two-wheelers are likely to grow by about 12%. Right now, we are just about 16% behind our pre-COVID levels. So a 12% addition this year, of course, will take us closer to that mark. Not that it's a benchmark, but I think when we talk about air traffic or whether we talk about, consumption per se, COVID becomes this sort of, differentiator pre-COVID and post-COVID. But coming back to the point, so we are looking at passenger vehicles to grow at about 14%, two-wheelers by about 12%, commercial vehicles by about 10%. Do you think some of this offtake of four-wheelers is also eating into the reduction in two-wheeler sales in rural? Do you see that as a trend emerging, that erstwhile two-wheeler or prospective two-wheeler buyers are actually upgrading to four-wheelers like we saw for the rest of the country during COVID? Public transport was ditched to get a hands on a car.
Not really, I would say.
Okay.
The matter of the fact is that if the two-wheelers are becoming expensive, but so are the four-wheelers. And so therefore the gap continues to increase between what a customer can really afford, between a two and a four-wheeler. And therefore, I don't think that that's one of the major reasons. It might be a small contributor, but certainly not a significant reason why you'd expect a slowdown in the two-wheeler sales.
Okay, and how do you see this, this whole OPEC cutting down on oil production, estimate suggesting that oil could very well reach $88 to $90 per barrel. Some reports also suggesting end of the year we could see it go up to $100 per barrel. So overall, do you think once this translates to increasing fuel prices for the retail consumer, do you think that could have some sort of a slowdown impact on the auto sector per se?
May not really, I would say, again, for the simple reason that for a lot of Indian consumers, when they look to purchase a two-wheeler or a four-wheeler, there is a fair amount of aspirational value associated with it. And I don't think customers really calculate at that level of detailing whether the oil price is going up or low. Also because oil prices are not something that's going to stay stagnant for a long time. So nobody can really predict which way it heads. So my thought here is that, it's more an issue of, the purchasing power of a customer, and everything has got a lot more expensive than it was maybe about a year ago. And if, for example, I'm a potential two-wheeler customer and I've just invested into maybe buying a home, which I also needed to, and taken a loan for that, and unless and only I can, for example, pay back that loan, I'm not willing to take a new loan to buy a two-wheeler. I don't think people have enough cash, and that's one of the big reasons why there's a likely dip. And the fact that the cost of the loans have really shot up significantly.
Right. So sort of what do you read into, let's say, what the World Bank also mentioned yesterday, the report released by the World Bank yesterday stated that that this slight moderation in India's growth at 6.3% is actually going to be on the back of reduced consumption, which is on the back of reduced incomes. So with inflation going up, income reducing, do you think inflation is going to continue to stick? And of course, we have the MPC underway right now, and the next decision on rate hike is likely to come tomorrow. But if at all a rate hike or it stays as is, we'll discover only tomorrow. But overall, this sort of double-edged sword of inflation increasing, sticking on, if not increasing drastically, while income reducing.
Yeah, it's a double-edged sword, and almost every industry at the moment is facing that sword. And the impact of that will, again, like I mentioned, is a lagging impact. So it's going to last for at least 2 quarters before we really see any new trend emerging. And people are postponing their purchase decisions as much as they can, given that they don't have surplus cash with them. There is obviously a lot of news coming from the tech sectors, the startup sectors, where funding has dried up. And for that matter, there are job cuts across the board. Not that it impacts the immediate larger economy in India, because it's still a very small proportion of the job cuts, which would create an impact, but it does create a sentiment issue. And when that usually happens, you can expect that some of the more significant discretionary purchases would get postponed, till you again start to feel comfortable with the amount of cash in the bank.
Right. And how do you see this whole supply chain issue panning out? I believe there is obviously, some ease in the electronic components, especially the semiconductors, but it still doesn't seem to be enough. So overall, how guarded are we on the production side to really thwart away these challenges which we are faced with externally?
I think at least for the last 6 months, the automotive companies have actually enjoyed a great joyride, if I may say so. And they've managed to create a huge pipe of potential customers, even though the semiconductor shortage continues to be a pressing issue. What they're also now worried about is that the demand is actually going to stabilize a lot more. So in a way, it would match up to the availability of semiconductors. So that lag that we saw, for some of the four-wheeler models, sometimes the waiting period of over 6 months, that might come down to about 2 to 3 months, and which basically means that the supply and demand would sort of stabilize to a fairly acceptable level.
Okay. Sort of coming back to the sales as far as, auto sales is concerned, we've seen four-wheeler sales getting better than pre-COVID levels at all-time highs. Passenger vehicles, SUVs. Whereas, when it comes to two-wheelers, we're seeing a dip, not so much as a dip, but not enough, not there yet as far as pre-COVID sales is concerned. What does it tell us about sort of income disparity in the country? Are these telltale signs of, rich getting richer and perhaps the middle class or the lower middle class not earning enough? Because there's no pent-up demand in case of two-wheelers here.
Yeah, that's right. So partly yes, but at the same time, what usually happens in the Western markets where the disparity is a lot more higher. In India, there are multiple levels, so it's not really a rich and poor. There could be almost as many as 8 or 9 levels between the rich and poor. So I don't think that we could simply generalize it. At the same time, what we've noticed is that, 1% of the super rich, have continued to sort of grow their wealth, but that also has seen actually a bit of a dip in the last couple of months. If you really see the performance of Sensex, which really is a reflection of that 1% of the rich promoters and founders, it's not really grown. It's not something that you could really see as a significant growth zone. So there is downward pressure on all sides. Not that it impacts their ability to make any significant purchases at the luxury level. So that market continues to grow really amazingly well. But yes, what you do see is that the willingness to pay higher increments to the larger employee base is gone down. The willingness to hire more people has gone down. So one of the biggest recruiters in the Indian economy is the IT services companies. They've had a significant downward pressure because of their order books sort of, depleting a little bit because of the global recession, and especially in the western parts of the market. So you for sure would expect that the cash in hand is going to go down. Real estate has become very expensive. If you're looking to even rent a space, if you can't buy, it's sort of gone out of a normal person's ability, to be able to afford, especially when you have the uncertainty of job cuts, on your head. So what you see here is maybe a short-term trend where people are likely to become more conservative as far as spending is concerned. But one can expect that, the India story is still intact. We do have significant investments happening across sectors. And so there is hope. There is a lot of optimism alongside. Okay. But we have to wait and watch the next 2 quarters at least, which could be a bit painful for most sectors.
Wait and watch for the next 2 quarters. That's the message coming in. Continue to stay with us, Saurabh. We're tracking another very important story, which is coming in globally at this point in time. Johnson & Johnson's baby powder. And this is for you if you're one of the users. Johnson & Johnson, the famed company for making baby products, has proposed to pay about $9 billion to resolve tens of thousands of lawsuits that it's currently facing in North America. The allegations are serious. That is, that the baby powder and other talc-based products can cause cancer. The company is facing more than 40,000 lawsuits from former customers who say that they used the talc and it caused cancer for them. Some allegations are also that the product contains cancer-causing asbestos. Now, Johnson & Johnson's stopped the sales of its talc-based product back in 2020 in the United States and in Canada. And last year, it also announced plans to end sales globally. But remember, the baby powder continues to be available here in India. Now, before the decision, the company had sold the baby powder for almost 130 years. The company continues to deny that its talcum powder poses any health risk, saying that the settlement offer does not constitute an admission of wrongdoing, and it says that the powder is safe, but had to end the sales of the powder because of the negative publicity around it. That, of course, is a very important story that revolves around consumers here in India and also abroad. With me continues to be Saurabh. Also here with me in the studio is Karthik. Karthik, there seems to be no end to Johnson & Johnson's troubles.
And rightly so, Shweta. I mean, they've been selling the product for the last 130 years. And what they're facing in the US and the world over right now is the classical class action, right? So this is a complete tort lawsuit. There are people coming out in thousands, 40,000 or so lawsuits. But unfortunately, the company continues to insist that this is misinformation and there is no scientific evidence around the fact that that there are ingredients in the talcum powder that could cause cancer.
Okay.
In India, of course, and not just in India, I think globally, Johnson's babies used to be, this typical cuddly child smelling of excellent fragrance of the Johnson powder. And I remember in my childhood and in my growing up years as well, a newborn child would always be gifted this Johnson's hamper, and that would be the most treasured gift that the parents would continue to use for a long time. I have a daughter, thankfully, our pediatrician had advised us not to use any cosmetics altogether. So thankfully, we never fell into that trap. But there are many, including me and many others of our generations and beyond, who've grown up on these cosmetic products, including those from Johnson's & Johnson. So, yeah, I mean, a $9 billion penalty, okay, sure, or sort of trying to offset whatever is happening right now. All right, but is that enough to sort of, wish away a lawsuit and get out of it smelling of talcum powder, if not smelling of roses? Okay. But I think it has to translate to the rest of the world as well.
Absolutely.
So if there is enough merit in the argument in one court of justice in the world, the same should apply for other countries as well. And I think if there is any iota of doubt that a product may not be safe for children to apply, it has to be pulled off the shelves immediately.
That is correct. Saurabh, tell us how serious are these allegations? We know that Johnson & Johnson has been battling those allegations, not just for the talcum powder, but variety of other products, but talcum powder in particular, because that is one of the more biggest forte of Johnson & Johnson. As Karthik pointed out, it is known for its baby products. How serious are these allegations? What are the repercussions back home in India?
Yeah, I think this is a very, very important, I would say, allegation, and because it again brings attention to the fact that we continue to be served as consumers with products which are suboptimal, presumably, and until proven. And as far as the baby powder business is concerned, or the baby care business for Johnson & Johnson is concerned, I mean, if you really see globally, it's a very small portion of the overall portfolio of the company. So I don't think they are as impacted on the revenue side as they are impacted, on their brand image or the overall image of the corporate image of the organization. As far as India is concerned, there have been some very, very proactive actions which have been taken. We do know that the Maharashtra government had banned the sale and manufacturing of J&J talc powder in 2022. But the reason for that was because of higher pH levels, where the permissible limit was about anywhere between 5.5 to 8, and the baby talc had about 9.8 pH levels. Similarly, the production got stopped at the J&J Mulund plant. And so there's been action being taken, but the matter of the fact is that if I go to Amazon right now, I can actually buy the product. There is a claim that the product is now made from cornstarch, and it no longer uses the same chemical combination which actually had the lawsuit against. So, but yeah, the trust deficit is very, very high. And as Karthik shared, you'd not want to trust it for your baby anymore.
Right. Saurabh, what does this do as a brand to J&J, not just, in the US, but in the rest of the world as well? So there were talks of J&J coming out against, with a vaccine against COVID-19, for example, and for whatever reason, it hasn't taken off. And at the same time, the company has very smartly followed what is known as the Texas two-step litigation process, where the talcum powder division was actually offloaded to a subsidiary which filed for bankruptcy. So they've sort of financially, been smart in evading direct liability. But then obviously there is a major hit to the brand J&J. So where does the brand go from here?
Yeah, you're right. And in fact, not just this particular crisis, and in fact, their attempt to shift it to the bankruptcy law has been put down by the courts, which is why they've now been forced to commit to it and to commit a fairly large claim value. Not that it's fully accepted yet, but it's not the first time that's happening to Johnson & Johnson. So you could say that a lot of the karma is really catching up. So just about 5 years ago, they were embroiled in a fairly significant opioid epidemic in the United States, and they were again a target of some very significant lawsuits. And they, along with three really large distributors, actually had to settle for about $26 billion. So they've been under this so-called lawsuit attacks now for a couple of years, and they have some serious thinking to do as far as their approach to product development is concerned, product marketing is concerned. I'm assuming that they would have taken some significant measures since some of these lawsuits really came up. But yeah, a lot of catching up for them to do. I mean, not that they have a significant drop in revenues overall as an organization, but the trust of the customers per se is really at an all-time low.
Okay, the trust there at an all-time low. Remember, Johnson & Johnson's is not in news just in the US, also in India a couple of years ago. And this is a story that I was tracking personally very, very closely, was the faulty hip implant. And that case is currently being heard in the court of law. J&J, a lot to answer, not just in the US, but also here in India, battling multiple lawsuits all across the world. Saurabh, thanks very much for joining us with your inputs on that story. We're going to shift focus. Indian corporate houses have got one over their American counterparts. Well, that is one way of looking at it. If we talk about office space leasing as a benchmark, a report by consultancy firm CBRE India states that Indian companies overtook American firms in gross leasing of office space during the first quarter of this year, with nearly 50% share in the total demand. This is the second instance of India Inc. pipping American companies in this parameter. The report noted Bengaluru, Delhi, NCR and Chennai accounted for 62% of the overall leasing of 12.6 million square feet in January-March this year, in contrast to the previous quarters where technology corporates dominated leasing activity. BFSI firms and flexible space operators drove space take-up with a share of about 22%. Joining us at this point in time is Abhinav Joshi, who is the head of research India, Middle East and North Africa, is going to join us very, very shortly. We're given to understand, and he's a representative of CBRE, but Karthik continues to be with me. Karthik, this shows that not just are corporates becoming more flexible, we're moving away from traditional office leasing, not just IT sector, but flexible office spaces as well.
Yeah, that's true. And I think what it also tells us is that the kind of job losses that the US has seen, India has not seen. So thankfully, there is still demand for office spaces. Secondly, I think this whole culture of hybrid, this whole culture of work from home, etc., may actually be a thing of the past. When we were talking about this in 2020, 2021, the assumption was that, there is going to be such massive business transformation that return to office is actually never going to happen. And at best, it's going to be a hybrid sort of a situation where you're coming to work only on a few days and taking, work from home as an option on other days. But that seems to be history. And the fact that despite COVID numbers rising yet again, I think last we checked, there were some 23,000 active cases in India. And this has only been growing at 4,000, 5,000 new cases a day. But the fact is that corporate India has realized, and especially the IT cities of Bangalore and Chennai, they've realized that perhaps work from home is not the most efficient for its employees. And these companies, incidentally, are the very back offices of work carried out in the rest of the world, especially the developed countries like the US. So again, now I hope this sustains, because at one end we are looking at a banking crisis in the US. We are overall looking at recession as a likely scenario. And the back office work for these sectors is done back home here in India, and these two cities in particular, in addition to these two, of course, Hyderabad being another city. But yeah, so as long as business continuity continues, and as long as the work keeps coming back to these cities, I think it's great news that that we are hiring more office spaces than other countries. Okay,
Abhinav is here. Abhinav, what are the prime factors behind India Inc. pipping American firms?
Well, the prime factors were around, the pent-up demand that we've seen since the last almost 12 months. Pre-COVID, the share of India Inc. used to be around 30-35% in overall leasing. Over the last 1 year, that's gone up to more than 50%. So as global firms, while they continue to prioritize India, and India is very core to their portfolio given our cost and scale advantages, over the last at least 6 months, we've seen some sense of caution, especially for large-scale transactions. But Indian firms are exercising their decisions. They're taking very fast decisions. They're not sitting on them. And whether it's banks or banking BPOs or financial services firms or smaller IT services firms or tech startups, they've been leasing spaces across major cities as well as in smaller markets. The other big differentiator is that, I would say the return to office has been relatively better from an experience perspective and from an occupancy perspective in Indian firms compared to the global multinationals. Occupancy levels have been relatively higher, and as a result of which they've been slightly more aggressive. And one major factor why India Inc. has done better is also because of the flex space universe. So our flex space universe, or the co-working or the managed space market, is primarily driven by domestic space operators. And they are taking spaces across the board, whether it's in Bangalore or Delhi or Dubai, Hyderabad, Chennai, even in tier 2 and tier 3 cities, because a lot of Indian and global firms need those touch points to connect with their employees. And if there is uncertainty around business projections or hiring projections, Flex, essentially feeds on that. These are some of the reasons why India Inc. has done much.
Okay. There's an interesting trend that we were talking about, which is BFSI firms in flexible spaces, as you mentioned, overtaking the dominancy of corporates, the tech companies that traditionally were leasing more office space. What does it really tell us about the great new mix as far as, economic setup in this country is concerned?
Well, I think there is a larger diversification that's happening of demand, if we can say that. We've never seen this before. In fact, for the last at least 10 to 15 years, we've been a tech-dominated market. Every quarter, every year, we used to see tech players dominate. They still have sizable quantum of interest and RFPs floating in the market, if you look at the pre-commitments and the transactions being closed. But, we've seen greater expansion from banking GCCs or global capability centers. Domestic banks, again, coming back to the point of pent-up demand. Since they had not exercised their leasing for almost 2 years, we've seen significant quantum of leasing from domestic banks, both for retail branches as well as for their back-end or, the BPO setups. But even in engineering and manufacturing, even when it comes to research consulting, even in sectors like aviation, telecommunication, because the domestic economy is performing relatively better compared to some of the more advanced economies globally, and the projections are also much better. The outlook is much better. So firms who are exposed to the domestic economy and domestic consumption, undoubtedly, they're slightly more aggressive as far as their office leasing plans are concerned.
Okay. And the fact that Bengaluru, Delhi, NCR, Chennai still account for 62% of the overall leasing, there's not been much of a change there. These areas continue to be dominated by people who are coming from all across the world and all across the country, to be particular, to come and work in these cities and these cities only. What about the tier 2, tier 3 cities? Is there an uptick there as far as the office leasing is concerned?
Well, office leasing, I would say, primarily is driven by these 6-7 markets, including Delhi, NCR, Mumbai, Bangalore, Chennai, Hyderabad, Pune, and Calcutta. But post-COVID, we've seen a revival of the tier 2 story. We've been through this tier 2 journey for the last 20 years at several points in time, but this time it looks very credible because there is a sizable quantum of talent pool, especially in the tech sector, which is still based out of these smaller cities. So corporates want offices over there and touch points to connect with these employees. The other very important point is that infrastructure-wise, all these markets, all these cities fare much better compared to where they were 5 years, 10 years, or 15 years ago. They all have airports, they all have under construction or completed metro projects. They have very strong road, expressway, highway connectivity, very strong footprint of retail. Residential is growing, purchasing power and consumption patterns are strengthening. So there are at least 15 to 20 tier 2 cities where you're seeing either multi-tenanted assets or built-to-suit developments or campuses being set up primarily by firms. So yes, there is credible demand. Of course, it's not of that same scale as the tier 1 markets, but it's definitely much better and more credible compared to 5-10 years ago.
Okay, Abhinav, talk to us about the rentals. Of course, we've seen rentals explode really in the residential space in these 3 cities particularly. What about rentals in the office space? Have they grown at the same clip as residential rentals?
Well, undoubtedly, we've seen recovery in rentals last year. They've gone up anywhere from 2% to 10% on an annual basis. And in the first quarter, despite all the talk around uncertainty and monetary tightening impacting, corporate profitability and a sense of caution by global multinationals, rents have gone. across markets. In a couple of micro markets in Chennai, they've gone up in a couple of micro markets in Bangalore, in some prime locations in Gurgaon and in the West as well. That largely conveys, that while the market for some time has been heavily tenant dominated, it's sort of becoming a more balanced market now. And quality premium assets where you have significant, quantum of amenities, facilities, prop tech, elements like sustainable, the entire experience that they want as they're coming back. Those assets are definitely trading at a premium compared to rest.
Okay, all right. Interesting updates coming in there as far as office spaces in India is concerned. I appreciate you joining us with all those details on that very important story. Shifting focus to Dalal Street now, Suyash is here with me. Suyash, how did the market perform?
So, Shweta, the Indian market has continued its winning streak for the 4th consecutive session today. Now, it was supported by capital goods, FMCG and IT stocks. At close, Sensex was up about 0.99% to close marginally below 59,700 levels. Now, Nifty gained about 159 points to close at 17,557 levels. In the last 4 sessions, Sensex has added roughly 2,100 points and it's up about 3.6%. Now the market participants will await RBI's policy decision which comes out tomorrow, that is April 6th. The word on the street is that RBI will continue on its rate hike path. This time the expectation is of about a 25 basis point rate hike. Now they will also keep an eye on RBI's on the commentary of RBI policy after OPEC's unexpected production cut and the recent cut in growth rates by Asian Development Bank and the World Bank.
Okay, those of course are updates coming in from the Dalal Street there. 1% jump in Sensex on the back of RBI's much awaited monetary policy. Remember, we are going to get an update on whether the MPC will cut hikes or will stay, will hike rates or will stay rate hike this time around. Also, important updates coming there from OPEC countries which are affecting the street. We will continue to track all the developments there in the stock market and on Dalal Street. Thanks very much for watching Business Plus.